Good morning. This is Mary Tressel, and I'd like to welcome you to our webinar today, Rolling Forecasts for Real-Time Financials. So first, I'd just like to walk you through using your webinar pane. You'll see the pane in front of you. Please note that the orange arrow will allow you to minimize or maximize the pane. If it is minimized, simply click on the orange arrow to bring it back. Feel free to submit questions that you have for our presenters anytime throughout the duration of the webinar, and we will handle those questions at the end of the webinar as time permits. All participants will receive a link to a recorded PowerPoint after the webinar within the next 48 hours. To modify your audio settings, if you're using your telephone to listen in on our webinar, please make sure you select Use Telephone. If you're listening through your computer speakers, please select Use Mic and Speakers. If you have the incorrect settings selected, it will produce an echo sound. Now I'd like to introduce our presenters. The first is John Denikin, a partner in our CFO Advisory Services Group. John has over 30 years of financial executive, operations, and consulting experience for both public and private companies. He's held positions such as CFO, VP of Finance and Administration, Treasurer, Controller, and Director of Operations. He's worked with many different industries, including technology manufacturing, publishing, service and distribution, and the banking industries.
Thank you, Mary.
Sure. Our second presenter is Brian Rogers. He's a senior manager in our CFO Advisory Services Group. Brian has over 25 years of financial executive operations and consulting experience, again with both public and private companies. His background includes extensive experience in FP&A roles from multi-billion-dollar corporations and as a consultant for multiple adaptive planning implementations. And you can see he's worked with a wide variety of industries as well. So today, by the end of the webinar, we hope that you'll be able to understand what it means to use rolling forecasts, review some case studies of rolling forecasts that are utilized by best-in-class companies, and you'll see a product demonstration of rolling forecasts in action. And with that, I'm going to turn it over to Brian Rogers.
Thanks, Mary. Well, thanks for everybody for joining us today. I think you're going to hear and see some pretty neat stuff and a different approach. I think that makes a lot of sense for really just about any company out there as they consider revamping perhaps their outdated budgeting process. So what we're going to talk about today is really, rolling forecast defined, of course, reasons for considering a rolling forecast. We'll touch on some case studies, and I'll do a quick demonstration about how a solution can really help you in this rolling forecast, how to do this. And next I want to turn it over to John Denikin, and he's going to give you a little example of how Armanino works with CFOs and kick us off. John?
Thank you, Brian. For those that don't know Armanino, I'll do a quick introduction of how we really approach business and working with our clients. We do surveys every year we call for the CFO, we call CFO Evolution. And essentially what we find is that very consistently, as you can see on the left, people spend the majority of their time, accounting organizations, finance organizations, the majority of time really in the accountant role, which is essentially closing the books, doing journal entries, producing financial statements, kind of the really nuts and bolts of the accounting operation, while they're spending a much smaller percentage of time, about 25% of the time, kind of really the business leadership role. And of course, when we turn that question around about how CFO organizations would like to spend their time, it becomes just the opposite. We're spending 50% of their time, or they'd like to spend 50% of their time really kind of in the leadership role, and much less time really in the accountant role, the blocking and tackling kind of role. Our objective as an organization is really to help you make that transition and really focus on being business leaders within your organization and spend much less time in kind of the nuts and bolts of the accounting by really streamlining and focusing on the people, process, and technology to make that happen. So one of the questions we always have is kind of where are you on the scale here? As companies grow, the roles of the finance department very much change as well. In the early days, it really starts out, it's dominated by kind of a real accounting role, a bookkeeping role. Over time, it becomes much more focused on financial planning and analysis, FP&A, really becoming business partners and ultimately business leaders. And that's really our objective to working with our clients, is really to help you make that transition and really become business leaders and part of your organization. A key part of that becoming business leaders is really the importance of forecasting and really be able to know where the business is headed at any given time. Most companies already do budgets, kind of the annual budgets, kind of see where you are, what you're going to do this year. The problem, of course, as we'll talk about more as we go through, is those budgets become stale very quickly. So at the base level, people will then start doing periodic forecasts, maybe semi-annually or quarterly. You'll do an update. And it's clearly advantages to that. It helps bring the budget up to date. It gives you some early warning signs about what's going on and really kind of, gives you a better view into the business. But, of course, the real goal to really become part of the business leadership is really to move to rolling forecasting. Because what that enables you to do is really have a very dynamic view of your business, really anticipate what's happening, really understand the drivers of the business and those key aspects that are really making a difference in your business. And ultimately, the goal is to be able to make real-time decisions about how to run the business, what changes you need to make, where you need to focus, what's working and what's not. So that's really the goal. And what we're going to talk about today is really how to become and move to a rolling forecast organization.
Very good. Well, first off, I thought I would kind of give you a little bit of a definition. You've got rolling forecasts, rolling budgets. You hear these terms thrown out a lot. I think when we look at it, rolling forecasts, it's really more of a trending of your business and where it's headed. Maybe you're going to tweak some assumptions here and there, but it's generally a view of your business, if nothing else, major changes. Whereas if you're looking at a rolling budget, and maybe it's a rolling projection or target, it's probably a better way to look at it, is this is going to include specific management actions that you've taken to address opportunities or challenges, that kind of thing. So there's a distinct difference, and I think what you'll see is the need for your solution to be able to handle a variety of different versions for that to be the case. When you look at either one, oops, can you go back a little bit quick on me there? so they're always available. When you're looking at a rolling period, you're gonna have, maybe it's a quarter, maybe it's a month, but you're gonna take that month away and you're gonna add it at the back end. So you're not budgeting or forecasting to just a 12-month period and then you just get closer to that end of the year, that wall. You're going to consistently go, okay, well, now I've added a quarter, I'm going to go out another quarter. I've added a month, I'm going to go out another month. So I'm going to drop that latest month off. So what it does is it continues to move the chains ahead and make management focus on the future. So, yeah. So just to give you a little example, maybe how this might look, and this is a very high-level example within the solution, but let's just say the company had a very high-level 5-quarter view of the business. Maybe they'd look at revenue, cost of sales, gross margin on a quarterly basis, and they'd tweak perhaps their assumptions on revenue growth, cost of sales, expense ratios, or changes from prior year. What they might want to do then is as they update a quarter, use those as a basis and foundation for their forecast, but then go out another quarter. Maybe we go to the second quarter of 2015. When I do the demonstration, you'll get a little better sense of the kinds of metrics and KPIs you can build in to really streamline this and make it a lot easier. So really on the next slide, as we look at it, why do you want to consider doing a rolling forecast? And John touched on a little bit of this, but first one, the static or annual, semi-annual budgets really become obsolete quickly. And I saw this a lot when I was at Allstate. I was in the planning and analysis function over there. We missed our average premium assumption for California one year, and I remember explaining essentially $1 billion shortfall in revenue for most of the year. And it turned out to be, basically a rate effectiveness and what have you that didn't come through. But the whole process, this took months to put together a budget that was essentially obsolete within a few months. So because
Brian?
of, go ahead.
Hi, Brian. This is Mary. I just want to ask you to lean in with your audio. So it's
Okay.
kind of going up and down. So if you can stay forward, and then the audience will be able to hear better. Thank you.
Sounds good. Okay. Yeah, so whether it's due to changing internal objectives, business industry conditions, changing competitor landscape, external factors, economy, world events, that kind of thing, you're going to want to have a budget in place that adapts to your changing conditions. And kind of like I mentioned, the business does not stop when the annual budget period is over. You want to continuously look beyond the end of the year to figure out what's going to happen, what are the risks, what are the opportunities. But I think the better thing is with this whole rolling forecast process is you want to force collaboration and better decision making. That's the real key. It isn't just an annual exercise that finance puts together that everybody wonders where the numbers come from. It needs to be a collaborative goal setting, a way to run your business on a regular basis. And that's kind of the last point. Rolling forecasts really become a key component to better decision making. And that's really what's key here. And next will be some case studies, and I think this puts it into perspective too on the next slide there. So when you look at companies that have adopted rolling forecasts, and there's quite a few of them, and what I've done is this CFO Magazine May 2011 article, Let It Roll. It's a very good article that touches on a lot of these companies. But you take a company like Unilever, it's nutrition, home, personal care product, multi-billion-dollar organization. They moved to an 8-quarter, I should say, rolling forecast. Norton Lilly, this is a business. They're in the business of ship agency services, logistics, brokerage, vessel planning. They moved to a 12-month rolling forecast, really of revenues and pre-tax goals. So they're looking at what's going on and where their business is headed. Statoil, that's a Norwegian oil and gas producer. And what they looked at with their budgeting is really saying, hey, they want to accomplish a couple different things with their budgeting. They want, expert and best-in-class target setting, forecasting, and resource allocation. And they found that their annual budgeting process really was really incenting poor behavior. You couldn't spend the money unless you had spent the same amount from the previous year, and there was a lot of different things going on there. So as they looked at their business, they also decided it made a lot of sense to go to a rolling forecast. American Century Investments, this is an asset management firm. They had about over $110 billion in assets. They moved to a quarterly forecast that goes out 6 quarters because, again, the same kind of thing. The annual budget wasn't providing a lot of value, wasn't giving, wasn't really creating the right management behavior that they wanted. And when you move to the next one, the Fireman Group, this is a real estate services company. They decided to go to a 12-month rolling forecast. And for them, they're a real estate services company, so the activities and what happens with their major tenants are critical to their business model and forecasting what's going on. So they cited things like a major tenant leaving or doing something different in their ability to react quickly as a reason for moving to rolling forecasts. Clements International, this is a global brokerage, global insurance brokerage firm. They needed to do much more scenario testing, contingency planning, and they decided that the rolling forecast was a better suited for their business model. Solo Cup, they do interesting. They do a monthly analysis, and then they try to figure out from that monthly analysis whether or not they've got a true change in their business, really, or is it kind of anomaly, one-time event, that they've seen, and then based on that, they figure out whether or not they're going to do a 18-month reforecast to reset their inventories. That drives a new production plan. So everybody's got a different angle. With American Express, they're a huge organization, split up. Really, you look at their travel-related, their Amex Financial Advisor, and their American Express Bank. Those are the kind of the 3 areas that they look at. But in general, it comes down to, for them, how could they make it all driver-based and incent everybody to really spend their time on the key metrics of the business and how that fits into not just a planning process, but a rolling and continuous planning process. And just to throw it back to John with a little bit more on the rolling forecast, what do you need for this foundation to work?
Thank you, Brian. As Brian was saying in the various case studies he talked about, each of these companies really kind of looking at the rolling forecast a little bit differently, although clearly there is some commonality among all of them that really is the basis for doing rolling forecasts. The key elements of a rolling forecast really are looking at the most recent actual results, kind of 3 to 6 months of what's actually happened. Rather than looking back to last year, you want to look at much more current data, 3 to 6 months, and make sure you understand what's driving that data. Has the business changed? Has it just been an anomaly? Is it seasonality? Or has some of the real fundamental drivers changed? And by just looking back at the current information or very recent past information, it's much more effective than doing the typical budget process of looking back to last year and saying, last year we did X, so this year we're going to do, X plus something. And by really focused on the key drivers and assumptions, you really kind of move a forecast. It really becomes a meaningful business tool. The other key thing that pointed out in a lot of the case studies that Brian talked about is that the rolling forecast is always looking beyond the current year. They're always looking out, in many cases, at least 12 months into the future, if not 18 months or 2 years into the future. So the rolling forecast, unlike a budget, which is looking at 2013 as an entity, you're always constantly rolling out further and further into the future, and you're always looking out 12, 16, 18, 24 months. That way it becomes very much a living document. So when it comes to the year end and you kind of get to that classic budget season, as it were, that really goes away because you've always got your future view of business. And that really becomes the key foundations for really building on the rolling forecast, is really looking at that current information and looking out into the future and the impacts of what that's going to be.
Very good. Yeah. So really some more reasons to move to rolling forecasts and just adapting to changing business conditions. I mean, I think we're driving this point home pretty well, but it's very critical that you have a budgeting process, a rolling forecast process that can be reevaluated against actual progress and changing business conditions on a regular basis. And I think that's really the key point of this best practice slide. And as far as adapting to changing business conditions, I mean, I think this point is driven home pretty well by this stat from the Beyond Budgeting Roundtable, where they found that the surveys they've done, 64% of the annual targets are really obsolete in 4 to 6 months. And I've seen that, of course, in my own experience too. Sometimes, like I mentioned, even less than that time frame.
Yes, as the survey showed, the Beyond Budgeting Roundtable, since budgets go obsolete so very quickly, what's really critical is that you're looking at the key business drivers and not looking back to last year. And really having a budget model that really is focused on what the drivers are and use those drivers as the basis for what happens in the business. When we talk about drivers, we're talking about things like sales volume, customer demand. On the expense side, on the cost of sales side, it would be things like your cost of products, your cost of materials. Rather than just looking at last year, looking at what's really going to move the business. So by doing that, the other thing that really forces you to do, or really forces the organization to do, which is in the long run very, very beneficial, is it really promotes coordination among the various functions. The sales department needs to forecast sales so that the operations knows what they're going to have to deliver, so marketing knows what the sales plans have to be, so that even folks in finance and operations have to make sure they have the proper salaries and the proper headcount. And by linking all of these business drivers together, you develop a plan that becomes very, very dynamic and can really help you become the leader, the business leader, really kind of drive the business forward. And although at first it can seem a little daunting to put this in place, it's really not that terribly difficult with the right tools. And once you've got it in place, maintaining that and rolling that forward becomes a very, very easy process that allows you to really kind of build the budget and really kind of develop the rolling forecast model that we're really kind of focused on today. So with that, Brian's going to spend a couple minutes and do a little bit of a demonstration of a rolling forecast using adaptive planning.
Okay, great. Brian, are you with us?
Can you hear me okay?
Yeah, now we can. Great. Go forward.
Very good. Yeah, so what we have here, so I've got my demo model up here, and what I thought I would do is just give you, a quick little rundown as to what you have in a solution like this. So look at something like your P&L. And this is adaptive planning. So what it is, it's a software as a service, subscription-based planning model. You're able to put in, it's a dynamic, really, view of your business between actuals that you see here, in green, and then as you get into your forecast periods, you move into the black. So you can tell instantly by looking at your screen what you're looking at. So this is an actual, this is a plan. It's very easy to flip the view on a given sheet, view by level, view by account, change your time periods, and basically how it interacts with Excel. Excel is very very efficient. But what we do when we're building these models, we want to drive in all kinds of different metrics, assumptions. I'll show you one page that has metrics on it. What we're trying to tell our clients to do on a regular basis is, let's look at financial metrics. Let's look at employee metrics. What are those KPIs that are critical to your business? Maybe it's revenue per employee, cost per employee. Maybe you've got a lot of drivers of your business related to headcount, average sales price of your products, and so on and so forth. But these are you're going to want to add not just financial measures, but you're going to want to add actually, units of growth and activity so that you can calculate your KPIs and report on them. But when you have solutions such as this, you're able to very easily go to different versions and update. Here's the version through the end of 2013. I want to copy this and then update it through the first quarter of 2014. That kind of functionality is simply built into the model. And let's say that you're doing a rolling forecast and you want to see your trend for that period. Well, you would simply create a report such as this. You could look at, what's my revenue, what are my expenses, how does that look for the last 12 months, get a rolling 12-month total compared to the previous years. You can select a different time period, simply hit the green arrow, and you'll notice all your numbers have refreshed to that current 12-month view. So it's a very effective and easy way to get a different look at your business, report, of course, on what you have going on, tweak your assumptions. Some other things that maybe you'd want to look at. There's variance analysis as an example, and you can set this up to be very flexible with the types of versions that you're looking at here. So you could compare actuals to working budget to perhaps a first quarter update, and you could fill out a report like this at will, perhaps, as you need to run your business. And you can change the look and feel of, maybe it's a total company, maybe it's the R&D view of expenses. Maybe you want to run, the G&A version of the business. Very flexible and easy to run through that. And then you have the ability, of course, to do. Let me show you one other different examples. So let's say that you're in the product P&L. You can, of course, run different reports that give you, revenue, cost of sales, gross profit, that kind of thing. And then when you get down more to scenarios, and that's where you can play with, okay, how does my current view of the business maybe compare to the last scenario I was looking at versus maybe the best case scenarios of the business, the worst case scenarios of the business. How does all that look? And are you able to toggle maybe it's best case compared to some of these other forecast techniques. But like John was mentioning, it really all begins with, getting your data into the solution, tying it all out, getting it all KPI driven and focused, and making assumptions really that are critical to figuring out, how do you want to run, what are the key performance indicators and things that you want to regularly access as you build formulas. Maybe things are triggered off of number of weekdays or work days. Maybe you've got different financial statement drivers. Gives you some examples of some of the things. And these are, very flexible assumptions that we can load into a model to make it all driver-based.
You can adjust that by, whatever a certain company's requirements are, Brian?
Yes, exactly. So what we do is we tailor-make these views and these assumptions to the company's needs. For instance, here's a view of travel. Maybe you want to have finance control what the domestic airfare, international airfare per trip is, and you require your managers simply to input the number of trips that they plan to take in a given month. You can put a lot more emphasis on the control and the standardization of a lot of these measurements. So when you look at other items on here, so of course, as you build out a complete model, what you really need to do is build a end-to-end. Here you've got your P&L, your balance sheet, your cash flow, expense look. You're able to do things with personnel, of course. We add in all our people. We can allocate them by department. Figure out, salaries, benefits, bonuses, that kind of thing. Capital is a robust component of the application as well, where you can put in your asset class, you build in lookup tables for depreciation schedules, and you tie those into, all these model results. You can tie into the GL accounts and then be able to drill into that level of detail. And this is an example of a sales planning sheet that we can do, by organizational level. You're looking at different revenue recognition methods and invoicing methods by product type. So it allows for a very flexible system, and the formulas associated with adaptive planning are very intuitive. You call the accounts what they are, full-time equivalents times average salary equals, total comp kind of thing. It's not an Excel, a cell reference from this worksheet times that worksheet where you're going back and figuring out where things are located. It's a relational database that's very logical and intuitive.
Speaking of that relational database, Brian, you're also able to do this by department?
Yes, exactly.
Okay.
So every single view, so take a look at your expenses. So you set up your org structure, you set up, dimensions, what have you, but you can easily set this up to say, this is a view of my expenses for total company. Let's see what that looks like by, for research and development. And you can simply enter in data just like that. You can carry it forward, to the end of your plan period. If you knew something was, say, $40 a month for the end of the forecasting period, you could certainly do that. You could enter data in the quarter and spread that back proportionally to the months of the quarter. You could do that for the year if you wanted to. And let's say that I spread that back. Oops. Spread that back. I'm using the fourth quarter. So, yeah, so that functionality, comes through there. So let's see. So, but I think the key to setting up, what we advise our clients is, make it simple. Put your natural chart of accounts in there. utilize an organizational level structure to really get you to figure out the best way that you want to really plan and interact with the solution, and then utilize dimensions really more for reporting and probably capital, personnel planning, that kind of thing.
Hey,
John,
Brian?
do you have any other comments? Yeah.
Yeah, Brian, we got a couple of other questions that have come up while you've been doing the demo. One of the questions people are asking about is, can you do different scenarios?
Yes. Yes. Matter of fact, here's a sheet on there. So this was the screenshot that I came up with, and there's a couple different ways of doing scenarios. You can certainly use, the versions, which is what you're looking at over here. And the versions are really, it's really one full-blown copy of the model. So in a version, you say, hey, I want actuals through this point in time, and I want plan to begin from this point in time, forward. So that's one way to do it, and you can easily make, like I mentioned, you can make a copy of that, change the assumptions, call it something else. Like in this case, I've done, here's a first quarter update. So that's a whole nother version, and it's an end-to-end copy of whatever version I selected. So if I did a fully blown integrated financial plan, top to bottom, income statement, balance sheet, cash flow, all of the different personnel, capital, revenue models, I would basically make a copy of that whole thing, tweak a couple assumptions, and I'd have a new version. But in this particular sheet, we've actually used dimensions at a higher level to look at, hey, what's a best case, worst case kind of view of the business if we're just going to focus on some of these key drivers and elements of the P&L. So we could certainly look at it like that. I mean, I think that the key point with adaptive is it's very flexible, and it's not a matter of can it do it, it's a matter of how do you want to do it, and what's the most effective way to get it done. But scenario analysis and updating forecasts is a regular part of how it's used.
Great.
Okay, good.
Yeah, Brian, another question that's coming in from a couple of people is can Adaptive integrate with different ERP systems, and such as Intact or Oracle, and how does it integrate with Salesforce? Can that be the front end of the sales forecast? So can you talk a little bit about Adaptive's integration capabilities?
Yeah, Adaptive has connected and integrated really through just your ETL process to all those solutions that you mentioned, and I believe we even have, well, we're an integrated component within NetSuite, to give you a little bit of example, but we've done a ton of work with Intact, and actually we've got some brand new clients that are doing just that, where we're actually working through the Intact to adaptive planning. How does the trial balance data, income statement, balance sheet, get fed into adaptive planning? And we work with the clients through that process, but it's actually quite easy, and basically just takes the time of your IT group and your company, and our team just sit down with you and say, okay, how does the data, how is it looking, and what signs need to change in your trial balance data coming into a solution like this? Where is it located? How do we access it? And again, by using the ETL process, that we're able to do that. You have any other comments on that, John, you wanted to add?
Yeah, actually there's a lot of very good questions coming in. And I guess in terms of data integration with other systems, we integrate with virtually all ERP systems. So I don't know if there's any ERP system we've ever had, any client has ever worked with that we cannot integrate with. So it is an extremely flexible system. When we talk about data integration, we typically are bringing in both actual data, so actual month results. We want to bring in, because we need that obviously for doing not only budgeting and forecasting, but most companies want to use this for all their financial reporting as well. And part of that is also the number of questions that come up about importing data or organization structures and account structures. And yes, we do import that information typically directly out of, whether it be Oracle, Intact, one of the Dynamics products, QuickBooks, whatever it is you're using, we can import those structures. And although this model that Brian has here is a fairly simple demo model, those organization structures can be extremely complex. It's a organization tree that can have many layers under that. So you can have multiple companies. In fact, adaptive planning has full international consolidation capabilities. So the old FAS 52 consolidation for multiple international operations. We have a lot of very large international companies that use adaptive. They can do their entire consolidation in there. So you can have multiple companies, divisions within companies, departments within divisions, and so on down. So you can import a very, very complex organization structures and do that full consolidation and reporting. Likewise with the chart of accounts, we can have multiple chart of accounts. If you're one of those questions being asked you, if you have a larger company that has multiple general ledger systems, which sometimes you do if you have multiple divisions, we can import that data across all of those from those multiple general ledger systems into one adaptive model, if appropriate.
Go ahead.
Okay, the other questions that I see a couple people are asking about nonprofits organizations. This sample model is kind of based on a for-profit organization, but yes, we have adaptive has a very large practice, and Armanino has very large practice in the nonprofit space. So we have quite a few nonprofit clients, as does adaptive, and so yeah, we work very frequently and very often with nonprofit organizations. So that is not a problem at all.
Great.
Brian, you want something else you wanted to show here real quickly?
Well, yeah, I was showing some of the graph capabilities, but real quick, just before you talk about even integrating to a solution, we start out with all our clients, working them through just the basic Excel import process, which is very simple. And this is a great example of what it looks like. I mean, it's a simple spreadsheet. Hey, what's the account name? What's the plan? What's the organizational level that it's going to? Maybe there's a dimension that we might have another column in there for company, region, legal entity, that kind of thing, perhaps. And then it's the the change in the trial balance account, month and year, or balance sheet. It's the end of month balance. Maybe we'll flip some signs if we need to. And but all companies really tend to start out with this Excel process, which works quite well. Certainly integrating to your GL is something that we recommend, and it is certainly a good idea. But if you're looking at the solution and saying, boy, I got to get this integrated right away, I would not necessarily say that that's critical. You can certainly utilize the adaptive process with Excel and get up to speed, get your data in there pretty quickly.
A couple other questions that are coming in is
examples of some dashboards. Go ahead. Mm-hmm.
Okay, real quick, a couple other questions that are coming in as Brian's kind of running through his demo here, because we talked about some of the large organizations and complex structures that adaptive can handle. So of course the question came in, not surprisingly, what about smaller companies, and does it make sense for smaller companies? And the answer is yes. Although we have some very, very large international clients, we also have clients that are very small that just have one or two users and fairly simple structures. Because what adaptive really, the flexibility it provides versus Excel or other reporting tools, really makes it a very valuable tool, even for much smaller companies, because you might be a smaller company, but the need to track the business, do the forecasting, and understand where the business is headed, if anything, very often is much more critical in a smaller company, because you're in a situation where cash is king, and being able to do an effective cash forecast and knowing you've got the cash on hand to do what you need to do becomes very, very critical. So to answer the question, yes, it makes a lot of sense for smaller companies. We do have a lot of clients with just one or two users, so that often does make sense. Talking about one of the questions that came in is basically exporting data back to ERP systems. So if you've got your plan in adaptive, can we bring the data, the budget information, back into the ERP system? And the answer is yes. Just as we can pull it out very easily, we can push it back to the ERP systems as well, whether it be Oracle, Dynamics, Intact, NetSuite, whatever it is you happen to be using. You've got the dashboards up there, Brian, so why don't you talk about those for a minute, because there's a couple questions about dashboarding and how they look and what they operate.
Yeah, so what we can do is really set these up specific to the user type. And you've got a lot of flexibility. Like here's a sales view And as you roll over these things, it'll tell you what the value is and what the time period is. You can drill into these kind of things, maybe by level, figure out what's behind it. Very flexible. You can pull these kind of reports up on an iPad as well. Works pretty good. I'll give you another view. But you have, and when you look at regular reports as well, you've got the capability, I don't think I mentioned this, you've got the capability, obviously this is an HTML report, but you could just as easily throw this into Excel. And really anywhere you are in adaptive planning, you can send the data into Excel and utilize it from there if you really needed to. It's very easy to, here's my look at the business. Maybe I wanted to change my time periods. I didn't care about the years. I just wanted to see the months. I'm going to save that, and then I'm going to throw that into Excel. And you can see that. But whether you're creating a discovery, you're in a dashboard, you're running a report to Excel, you're doing an HTML, and there's all kinds of formatting capabilities too on the solution that I think is pretty good.
Okay. Hey, Brian, we're getting a couple questions related to notes, the ability to put notes in the reports for people to comment on variances. And whether or not, and then of course those reports, to answer the question, yes, we can produce those notes, can be printed, included in reports, in addition to being on screen. But why don't you show real quickly how the notes work? So, because there's a couple questions about people about adding notes to the reports and the data.
Yeah, so here's an example. As you can add a report note, you've got that functionality here. You can add it to display on a line. It'll tell you who's making the note. You can put it actually on the report. You can actually make notes within cells and then report on some of those. So I can be here and say, add my note, new expenses. And then you'll see, every little piece of color on adaptive tells you something. So the blue tells me there's a formula for telephone, so it's head count times telephone. The red tells me I've got a note, and then I can roll over that and say, oh, it's Brian made this note on October 10th. But similar with reports, you can add it to the report. You can add it by line in the report. And you can see you could have footnotes at the bottom. Any other questions?
Okay. So there's one of the questions. So I guess the next question is kind of a more generic kind of question about pros and cons of tracking rolling forecasts. The question is 13 or 24 months. And so how far out you want to go, whether it's 12, 18, 24 months, is really kind of a function of your business and how you operate. You do want to always be looking out, though, on a rolling basis, because really what that gives you then is it really helps you understand what's coming. The classic, first of course, the classic budget is to do a budget for 2013, and now a lot of companies are doing their 2014 budgets. But what happens then, of course, if you've got a 2013 budget, when you get to the latter part of 2013, you're only looking out a few months beyond the fact that even if you've updated the forecast for 2013, you're only looking out a couple more months into the future. Whereas if you're doing a rolling forecast and you're always looking out a year, 12 or 14 or 18 months, it gives you much better visibility as to really where the business is headed. Because in today's environment, we can't be making decisions based on what's going to happen just within the next 2 or 3 months, but really looking out into the future and understanding how our changes or decisions today are going to impact those future months and those future periods really become critical. So it is a tremendous benefit to looking out further. And also, as I said, when it does kind of come to year end, and like we are now getting to the latter part of 2013, when you're thinking about 2014, your budget's really, you think about your classic budget period is really already done, because if you're looking out 16 or 18 months from now, you're already through all of 14. So while it's always just a question, just kind of updating assumptions to reflect what's really happening in the business today and what you know today, rather than kind of sitting down and recreating that on an annual basis for a one-time deal on a budget that's going to be obsolete in a couple of weeks or a couple of months. So yeah, so the benefits truly are giving you the visibility, looking out into the future. Okay. Are there present models? So I think I guess we have one last question on the demos, Brian. I'll let you kind of address here. And the question is: are there preset models for different types of businesses, or are you always creating them from scratch?
Well, we definitely have all kinds of demo models that we reference and use and learn from and kind of steal things from, if you will. But yeah, typically we're custom making the models by client. I mean, it's and I think it's a lot more effective that way. We certainly can institute and utilize our own best practices and experiences, because we're a team of folks that don't just sit around and build models. We've been in your shoes before and doing this work long before we had a solution to help us do it. So we have a pretty good idea of what can be done to make it a lot more effective and streamlined. But we do tend to have a lot of companies and a lot of different varieties of industries that we've learned approaches and procedures that really are effective, and we of course utilize those. And we've had some other demo models. Really, we've got a whole series of industry-specific demo models that we utilize here and there. But typically, we will custom make it by client, though.
Yeah, I think that's really the key there. Is that even though you might have two companies that are basically in the same industry, is they all look at it a little differently. So while we do have demo models, and we've built models in different industries for different types of businesses, they are all different. Everyone has their own chart of accounts they use. They all have their own organization structure. They all have their own key drivers and products. So while there's commonality, and we've certainly learned across those commonalities, both from our personal experience as working in organizations, but also building models, they are always customized because every business is different. So we do need to be able to do that. So it's a little bit of both. We're not starting completely from scratch, obviously, because we have a lot of institutional knowledge and models we've built in the past, but they are always customized very much around your business, your chart of accounts, your organization structure, and the way you look at your business and the way you operate, which is going to, of course, always be different than the guy next door.
Are we going to wrap up the demo now, or are we done?
Yes.
Is there anything else there that you'd like to show, Brian?
No, I think we've covered it. Back to John.
Okay, great.
Okay. So there are more questions which we will. I don't know if we'll get to them at the end here or not, if we have time, otherwise we can address them offline after the webinar is complete. So if we didn't get to your questions, there've been a lot of questions rolling in. I don't know if we got to all of them or not, but we'll always circle back with you if we've missed you along the way. And if we did, I apologize. So I just want to spend a couple minutes talking about why use a tool for rolling forecasts. Probably everyone on this webinar has Excel on their desktop. They use Excel for all kinds of things already. So really, why use a tool? Why use a tool like adaptive planning to do that? And the reason really is it really simplifies in the long run the whole process and really makes it much more bulletproof as opposed particularly Excel. And even a lot of tools like Hyperion and Cognos and some of those higher-end tools can be very, very difficult to use. What it really does is by using a tool, it really allows you to be very consistent without having bad budget data from resulting in spreadsheet errors. Spreadsheet errors are the bane of all budgeting and forecasting. It also really lets you focus on the analysis and understanding the business as opposed to spending a lot of time processing data. If you've used Excel, and I suspect pretty much everyone on this webinar has, rolling up a big Excel model can be very, very difficult, especially when you have to send out Excel files to all kinds of department heads, division managers, budget managers, companies, and have them all send those files back to you and reconsolidate all those, do all those imports, consolidate those files back. Invariably, people want to add their own rows and columns and change your files, and as I'm sure you're painfully aware of the time that takes. And let's face it, there's really no value added to any of that. It's just a lot of time spent processing data and moving numbers around. Whereas by using a custom-built tool, you really that process becomes almost instantaneous, and you can really focus on looking at the numbers, the analysis, and what it really means. And of course, what that does is it really drives the efficiency and flexibility of the budgeting process. The rolling forecast, if you try to do rolling forecasts in particular